In this episode of the Seatrade Maritime Podcast, we'll be talking to Adam Kent from Maritime Strategies International about the outlook for the shipbuilding market in the second half of 2025. Adam, perhaps you could just give our listeners a picture of the shipbuilding market in the first half of the year.
Yeah, of course. I think that the first half of the year from a shipbuilding perspective has been the same but different. Container ship contracting has continued at sort of the high levels that we have seen effectively for the last few years. And we've also seen high orders for sectors such as cruise and RoPax. But container ships have actually represented around half of all the contracts placed over the course of 2025. And for all other sectors, we've seen some big drop in volumes. Tanker contracting, we think, is down by around 2/3, and bulker and gas carriers down by about 80% from where we saw them this time last year. So a huge drop-off in contracting volumes so far this year. I think that obviously the geopolitical turmoil is causing some owners to sort of sit on their hands and wait to see what actually happens. And as we've seen sort of a softening in a large number of the shipping sectors and an easing off of the new building price, I think that's also causing owners to sort of sit back and take stock rather than ordering new ships. I think from on a plus side perspective, when it comes to sort of decarbonisation, given the heavy volume of both cruise ships and container ships that have ended up at the shipyards over the course of this year, around 50% of all vessels ordered over the course of 2025 year to date have been for dual-fueled vessels. So that obviously is a positive movement towards a sort of decarbonisation of the global fleet.
Okay, so, I mean, overall, a lot less ordering. The container ship ordering market does seem unstoppable. Every time we seem to predict that it's going to slow up, it doesn't. I think one of the factors we've seen this year has been the whole USTR investigation into Chinese shipbuilding, and then the port fees that are coming up for Chinese-built ships and so forth, and those are owned by Chinese companies. How much impact has that actually had on ordering?
Yeah, I mean, it's an interesting point. Ordering in China has fallen a lot over 2025, or the first half of 2025. Approximately a third of all orders have ended up at Chinese shipyards. Now that compares with around 70% over the course of 2024. So a big drop in sort of orders heading to China. Now, some of that may have been driven by the USTR for sure, but I think also we have to sort of focus on where the orders have come from. And as I say, there's been a lack of dry bulk orders placed over the course of the year. And with China still being the sort of predominant builder of dry bulk vessels, I think some of the statistics are being driven by just the lack of ordering within specific sectors as much as the US TR. I think China does seem to there have been some tankers, there have been some container ships ordered, and China's struggled to attract those volumes. But of course, we're looking at quite small numbers of ships being ordered, and the relationship between the owner and the yard, once you start unpicking that, it may not fully be a USTR perspective, but the sort of owner-yard relationship that's partly driving the sort of move away from China. But there is uncertainty with the USTR and the port fees. And I think it is, talking to owners, it is causing owners to sort of think about whether they ought to be building in China. I think the thing is with the USTR is the directive that was initially tabled was a lot larger than the one that we have now seen come out after the consultation period. I think if the USTR had stopped at when it was announced in February and at those levels, then perhaps we'd have seen a fuller and longer sort of steer away from Chinese contracting. But realistically, the USTR is going to be penalising a lot more significantly Chinese-owned, Chinese-operated vessels rather than the Chinese-built vessels.
Okay, so it's perhaps not quite as big of a factor as you expected, although that is a big shift in terms of the ordering balance in the first half of the year. So is this good news for the Korean and Japanese yards?
Without a shadow of doubt, it is going to be good news for both the Koreans and the Japanese yards. I mean, people are going to consider the economics of building a vessel in China. We historically, Chinese vessel new build prices have been, in some cases, significantly, and others marginally below those that you'd expect to get from Korea and China. And that's predominantly been on a sort of build quality basis, certainly 10 years ago or so. I think even if an owner isn't going to trade their ship into China or isn't going to charter it out to a charterer that wants to utilize it going into US ports, I think that they will be considering that when they buy a ship, when they come to sell it in the future, whether there'll be a discount associated with having a Chinese vessel, i.e. the buyer market may be a smaller pool because the potential buyer may not want to buy a Chinese-built vessels because it does come with an economic disadvantage. So, yeah, I think that the Koreans and the Chinese yards will sort of pick up some of the pieces for those owners that want to keep options open, either trading into the US or for when they ultimately come on to sell their vessels to the wider market.
Okay, so it does sort of change the dynamic a bit. One of the other things we've seen at play this year has been consolidation in the Japanese market. Is that going to be enough to sort of stem the tide that sort of Japanese shipbuilding seems to have faced?
Yeah, you're right. And I guess it potentially is a little bit surprising. As you say, there's been a sort of a drawdown in Japanese shipyard capacity and Japanese shipyard output over the course of the last 10 years, realistically. And we have seen a number of announcements over the course of the year so far with regards to consolidation or investment or joint investment in yards coming out of China. Obviously, the larger yards do have, there are efficiency gains to be made. And especially as we sort of move into sort of decarbonisation world, there are, collaborations on designs and technologies also comes to the fore with larger yards. I think Imabari taking a major stake in JMU will certainly put that larger yard in a better competitive advantage. And they're both yards that sort of bringing different sort of strengths to the tables and very sort of complementary in that regard. So I think that's a positive for the Japanese market. And we've also seen the Japanese government step in. They're sort of consciously looking to try and revitalize the Japanese shipbuilding industry. They've announced a $7 billion shipyard fund and the potential establishment for a state-backed shipyard with the aim to ultimately push Japanese market share back up to sort of near 20% of global output from the sort of 10% that they're currently sitting on. So a positive move there. And I think also positive, both for Koreans and the Japanese, is that we've also seen a number of other governments around the world, most prominently India and the US, sort of come out over the course of the last 6 months with their own shipbuilding directives. And we've already seen places like Hanwha take investments in the Philly yard in the US. We've seen Hyundai sign a JV with India's Cochin shipyard. And I think increasingly, if places like the US, places like India are really going to succeed in shipbuilding, the easiest way for them to do it is to form JVs or joint ownership with yards that have originally emanated out of Korea and Japan. And of course, that's where a lot of the NACs and the DACs of the world in China have been able to succeed so well by having these JV partners with the Koreans and the Japanese.
So some potentially interesting dynamics going forward there in the actual overall market. Just to sort of round this out, what's kind of the order book outlook or new orders outlook for the rest of the year and sort of beyond that?
Generally, we think that the remainder of 2025 will sort of play out from a volume perspective in a similar manner than the first half of the year is. So our aggregate sort of contracting total for the year is around just over 60 million GT, and we've seen just over 30 million GT ordered over the first half of the year. Container ships will continue to take the lion's share of that volume, and we don't really see a huge rise in bulker tanker gas carrier orders in the second half of the year, because we think all of the tonnage that was going to be ordered was ordered last year, and as everyone will remember, last year was the second highest year ever for contracting volumes. We're currently forecasting contracting to drop a little bit further next year into 2026. I say this somewhat cautiously, we can't see container contracting to continue to run at the levels that we have seen it running at the course of the last few years. But admittedly, we and many other analysts have been caught out by the container ship market and just how much tonnage has been ordered over the course of the last 5 years. So you can never say never when it comes to containers, it was soon. I guess once yard prices start to soften, once we see shortening in yard lead times, when we perhaps see a bit more clarity on things like dual fuel ammonia engines and actual engines working on the water, we do expect to see an uptick in volumes. But realistically, we're sort of forecasting that to occur more in sort of the 2028 era rather than over the course of the next 20 to 24 months. And generally on the new build price side, it's something that we've been saying for some time. We did expect to see a softening in new building prices. That it has now come to fruition. If you look at a VLCC price, they've sort of dropped from around 130 million at the start of the year to sort of 125 million now. Capes have dropped from 76 million to 74 million. So we are seeing that softening in new building prices, and that was always going to happen once we start seeing deliveries outstrip contracting and sort of yard forward cover falling. The only armament that the yards have in those situations is to drop prices to try and attract sort of owners to place new orders, and we're starting to see that, and we do expect to see that having some way to run as we sort of move forward over the course of the next sort of 18 to 24 months.
Okay, thank you, Adam. Very interesting to see how all this plays out and whether the container ship engine does finally run out of steam in terms of ordering new ships.